Today, we're going to talk about the Federal Reserve and monetary policy. Specifically, on the 26th of April, the Personal Consumption Expenditures Index, which is the Fed's preferred measure of inflation, ticked up to 2.7% when everyone's been hoping that's going to tick down.
Wait a minute, everyone. Welcome to Bitcoinzilla, your platform for daily cryptocurrency analysis and news. Our mission is to keep it simple. Bitcoinzilla offers engaging information that is easy to understand. Our analysts keep their eyes on the latest news to provide valuable insights via email. Don't miss out on this opportunity. Join our community of 10,000 subscribers and experience the new edge with Bitcoinzilla. Subscribe now. In this video, Peter Zeihan will share his insights on Federal Reserve's monetary maneuvers and the unexpected uptick in the Personal Consumption Expenditures Index. Will inflation continue to rise, or will it take a much-anticipated downturn? Let's join Peter Zeihan in this interview about these topics and more.
The folks on Wall Street are starting to get very thoughtful because they had all bet in the fourth quarter of last year and the first quarter of this year that by now we would have had a half a dozen rate cuts to stimulate the economy, and the Federal Reserve does not seem interested at all in playing to their preferred narrative. So I thought it was worth going back to understand why we are where we are and why you should not expect rate cuts probably at all, if anything, rate increases for the remainder of the next 2 to 5 years. So, step one. Most of the inflation story that we've been experiencing of late has been COVID-related. Every time that we saw a shift in consumption because of an opening or a closing or new variant or new vaccine, whatever it was, we changed what we consume in terms of goods. And every time we changed our consumption patterns, we had to retool the supply chains to match the new demand. And it's going to vary wildly by product and by region, but on average, you're looking at an 18 to 24-month adjustment period before supply chains can catch up to what we want. Well, most of us reopened more than 2 years ago, and California, the last American state to reopen for good, did so just under 2 years ago. So for the last 2 years, we've been seeing inflation steadily tick down as supply chains catch up, and the goods mismatch and the supply chain mismatch becomes a smaller and smaller feature in the system. Unfortunately for the people who want lower rates, while this has brought inflation down from 9%, where it roughly hit at the peak, to something closer to 3%, we've leveled off at 3%. And while we might have a little bit more to shake out as California fully comes back into the system, I doubt we're going to get down to the 2%, which is the ceiling that the Federal Reserve prefers. So we're probably at what is our new normal for inflation lows, not our new average. And unless we have a change in the Fed's mandate, you shouldn't expect interest rates to go down below where they are. If anything, you should expect them to go up. Now, that requires understanding a couple other things that are in play. One of them is a little petty, and one of them is definitely not. First, the petty one. The Federal Reserve looks at Wall Street and it says, you have been dealing with capital inflows of a huge volume, and you've been fairly irresponsible with them. You're responsible for the dot-com crash. You're responsible for the subprime crash. And we needed 10 years to rebuild the financial sector after each of those catastrophes. So if there's something that people in Wall Street and the financial community think, oh, well, this has to happen. Well, it has to happen for their business plans. It doesn't have to happen for the United States economy. It certainly doesn't have to happen for the real economy. And it certainly doesn't have to happen from the Fed's point of view. So there's probably a certain amount of wry revenge in play when the Federal Reserve looks at what Wall Street wants and then chooses to do something completely different for independent reasons. The second issue is that there really are independent reasons. And for that, we have to look at demographics. So when you're 45 to 65, that is when you're the most capital rich that you will ever be in your life, because your kids are moving out, your house is being paid down, and you are saving your money for retirement. Also, you've been at your job for decades, you're pretty good at it. Your income's the highest it will ever be.
Michael Saylor, MicroStrategy's founder, likens wise Bitcoin investment to choosing the Holy Grail amidst a market dip and regulatory speculation. Known for his unwavering support of Bitcoin, Saylor compares investment decisions to selecting a Holy Grail, as seen in Indiana Jones and The Last Crusade, urging for wise choices in the volatile crypto market. Recently, Bitcoin's value fell by nearly 5%, dropping from $63,284 to around $60,300. Despite this, a minor rebound has brought it back to approximately $60,920. Crypto analyst Michael Van de Poppe suggests that Bitcoin could potentially drop further to between $55,000 and $52,000 if it doesn't hold its current range. Saylor has expressed concerns over altcoins like XRP, Sol, ADA, and ETH, predicting they may face regulatory scrutiny, with Bitcoin potentially standing as the more secure option.
So from 45 to 65, and especially 55 to 65, that is where all private capital comes from, the savings of that capital-rich group. Well, the largest generation we've had in human history are the baby boomers, not just here in the United States, around the world. The oldest baby boomers hit 45 in 1990, and the youngest baby boomers will hit 65 and retire and liquidate all their money or all their savings into low-velocity investments. They'll retire in 2030. So from roughly 2000 to 2020, almost all of the baby boomers were in that capital-rich portion of their lives. And as a result, capital availability on an American basis, on a global basis, was the highest it ever been. Capital costs were the lowest it was ever been. And in that environment, the Fed will be the first to tell you that made American finance really matter. Because there is no way the United States could metabolize all of the baby boomer capital. So an entire financial class rose up to take advantage of the trough and to come up with new financial products to metabolize it and send a great amount of it abroad. At the same time, the Chinese were going through something similar. From 2000 to 2020 is roughly when their economy was firing on all cylinders. And while it's not based on private savings to the same degree as ours is, they do a lot more monetization, which is a fancy way of saying printing currency. All the gold bugs and the crypto guys, to a certain degree, are right that that's not great, that it puts everything on a sugar high. But the Chinese central bank is the one that's guilty of that, not the U.S. Federal Reserve. Anyway, for 20 years, we had all this capital just spamming out of the United States and out of China. And Wall Street was necessary. The financial sector was necessary. A wave above, bottomless wave of financial professionals was necessary to use all that capital. And did they get it all right? No. None of us do. Anyway, that wave's gone. The vast majority of the baby boomers are now retired, and the rest of them will leak out of the system over the next 5-6 years, which means their capital's gone. It's been turned into low-velocity investments like T-bills and cash. The next generation down, Gen X, is small, and the next large generation, the millennials, won't be entering that capital-rich period for another 10 to 12 years. And that assumes they do everything on time. And to this point, whether it's having a kid, buying a house, or getting married, the millennials have been doing everything about 6 years late. Anyway, bottom line is there's not nearly as much free capital available, which means we don't need nearly as large of a financial sector. And so the Federal Reserve is looking at all this, and they're like, there's less capital, demand is falling, our tools are designed to regulate capital and demand. That means we need to find a new model. And in this new model, the financial sector is no longer all-knowing, all-seeing, and omnipresent.
In the first quarter of 2024, CleanSpark, a U.S. Bitcoin mining company listed on the stock market, reported revenues exceeding $111.8 million. The company's net income for the same period was $126.7 million. Gary A. Vecchiarelli, the CFO of CleanSpark, partially attributes the company's record-breaking performance to the surge in Bitcoin prices. Non-fungible token, NFT, sales from May 4 to May 11, 2024 saw an 11.35% decline compared to the previous week's figures. Leading the sales, Bitcoin-based NFT transactions totaled $49.8 million, yet this was a 13% decrease from the preceding week. Over the past 19 days, the stablecoin economy has stabilized with negligible growth after reaching the $160 billion threshold at April's end. Out of the top 5, FDUSD is currently the frontrunner in terms of 30-day growth, showing a 15.3% increase in supply. If you've been with us so far, a big thank you. Don't forget to subscribe for free to Bitcoin Zella for your daily news. The link is waiting below. That's all for today's crypto news. Stick around for more updates, insights, and analysis on cryptocurrencies. Share your thoughts in the comments, like this video, and subscribe for more exciting content.